Hi, well, hi everybody. I know you guys are getting tuned in right now, so I want to thank you for everybody that's joining in today for the workshop. And if you're not joining in today, I want to thank everybody that's going to be watching this from here on out, because we'll be sending out the replay on this, and then we also, I believe this one we put on our YouTube page, so you'll be able to go and view this in the future. If you don't have the information now, or there's information that you forgot about and you want to go back and get, I think it's important that we put that information out there so we can help you guys out, and always try to continue to give you, good education, and give you my thoughts, so you can make better decisions for yourself, depending on whatever your situation is. So today we're going to be talking about buying profitable rental properties. Now, I haven't done this presentation actually in a couple of years. When I went back to look, it's been quite a while since I've done this. And the thing about buying rental properties is there's a lot of different ways we can buy rental properties. We'll be talking about that today. I'm also going to talk about how I have bought all the rental properties that we own and reasons why we buy them the way that we do, because I have bought several different ways over the years. And I have found that the way that we buy now has been the most profitable by far. And also, I think that there's a lot of very big misconceptions about rental properties out there. I see tons and tons of information sent out all the time, and I just think a lot of it's really bad information. And if we don't do this all the time, there's a lot of things that we don't think about or know. And I think everybody just thinks that they can go buy any property anywhere and turn it into a rental property, which you can. There's no doubt about it, you can. But how long is it going to take you to make that property profitable if you just do that? So I'm going to try and give you a lot of tips and things to look at, how I've looked at things, and should be a good class, and hopefully you're going to get a lot of information out of it. By all means, if you've got questions, please send your questions in. I'm more than happy to answer questions at the end and see what we can do to help you out. So with that being said, let me share my screen. Oh, hold on just a second. Before I do that, let me turn that off. Now I'll share my screen. All right, much better. Now you don't have to look at me while we're going through this. So buying profitable rental properties, I'm just going to get right into it here, because I think that this is a topic that we just need to get after and get going with. So, buying profitable rental properties. So here's something that I see done all the time, and I just don't understand it. But why would you pay more for a property that you want to keep as a rental property than you would if you're going to flip this property? This drives me nuts. Why would you not buy that property using the same numbers and the same strategy and the same methods? A very good example. Well, let me go through this and then we'll go back to that. And another thing that I think is very important that we're going to talk about today, and I'll even give you some examples, is, do we even think about our rent ratios? Most of us never think about rent ratios. If you're talking to some of the big gurus out there, they never talk about rent ratios. And then if you're looking at standards across the United States, the standard rent ratio across the United States, everybody uses the 1% rule, which I think is, you're going to have a lot of years where you don't make money, and it's going to take you a long time before you put yourself in a profitable position if you use the 1% rule. And I'll explain that and show you with the example, so you understand where I'm coming from when I talk about that. And then something that's really, really important, especially when we have rental properties, is how do we plan on financing these properties? Oftentimes we don't give it a lot of thought, and there's many, many methods that we can finance rental properties through, if we know that we have alternatives out there other than our standard methods of doing that. And we'll talk about that more when I'm talking about going into numbers later on in the presentation. So, but these are some things I think are really important for us to know. And when I talk about, how we look at deals, all the time I see people send properties out and they have two different scenarios. The property's this price, and if you only want to keep it as a rental property, you only have to do this much of a rehab. And if you want to flip the property, you have to do this much as a rehab. So that's one of those things. I think it's very, very misunderstood by most. And as we go through this and I get into some numbers and explain some things, and I'm going to talk from this perspective of owning rental properties myself, I'm also going to talk from the perspective of the lender, because we also lend as well. And it makes a huge difference in our perspective of how we're looking at these properties out of the gate. And I want to make sure that regardless of what direction you go, at least you know to look at the different scenarios before you jump into a rental property. So, have we decided what kind of rental properties we want to own? There's a wide variety of properties out there, wide variety of areas in town that we could own rental properties in. How are you going about figuring that out? How are you going about looking at that scenario? Do you have certain areas of town that you want to own rental properties in? We've been very specific and very strategic in buying rental properties. And we have rental properties in neighborhoods where there's a lot of rental properties, because it attracts more tenants to those neighborhoods. We've done that on purpose. We've got certain areas of town where we like to have rental properties based on the demographics, based on price point of the house, so many different things. And oftentimes we don't look at this a whole lot. And as we go into this farther and we talk about rent ratios, I will show you with the numbers how thinking about this works really well prior to getting into it. And it also helps you narrow down where you want to look, where you're going to be searching for properties. What do you want to be doing? And then I think even more important, because I hear this a lot more from people than not, is, are there certain areas of town that you definitely do not want to own rental properties? I think most of you know that we like a lot of the medium and lower end price point rental properties, because they're definitely more profitable. At the same time, we don't want to go into war zones. We don't go into war zones. And there's certain areas in this town, the greater Houston area is a big area. And there are definitely areas that we stay away from on purpose. At the same time, I can say that about some very high-end areas, because I know people that love high-end rental properties, and I do not. It's very difficult for my numbers to work with high-end rental properties. So there are areas that I stay away from, even on the expensive side when it comes to rental properties. But we really define where we want to work, where we want to have rental properties, where we want to have owner finance properties, generally where we want to flip properties. Not that we can't do all of the above in all the different areas, but we really try and target prior to going into an area doing something, because I believe it always gives us a better chance of focusing on what our end goal is and finding the type of properties that we want. So I think this is something that, like I say, oftentimes we don't really look at this that much. I think the biggest thing we look at is where we don't want to be, often way more than where we want to be. And really, for most people, the most common thing I hear is, I want to have rental properties by where I live. That's probably the most common thing I hear. And for most landlords, I would say that probably holds pretty true. I will also say that for most landlords across the United States, most landlords will own 1 to 3 properties and never own any more rental properties than that. That is by far the larger average than the way I buy rental properties and the number of rental properties I want to own, and the number of rental properties that I have owned over the years. So I just think these are some things that we need to think about as we're going into this. I mean, owning rental properties is great, and we're in a time out there right now where rental properties are popular. This is a very popular strategy, but I want to do it where I'm going into the deal with equity and profit right out of the gate. I don't want to have to wait for years to get to there. And I know that because I did it the other way when I first started. So I've learned a lot of this from experience. So what price range do you want to stay in for your rental properties? What ARV range do you like? Like I said, for us, our ARV range, we have really been big on, I like an ARV range for rental properties from probably 100,000 up to about 100, 150, 160, maybe a little bit higher. That's my sweet spot. That if I kept rental properties at ARV in that area, if I'm buying them correctly, those are by far the most profitable rental properties that we own. I mean, I'm talking 2-3% rent ratios, and even 4 in a couple cases with a couple properties. Very, very profitable in that price range. What we have to understand is the higher priced properties that we buy as rental properties, our rent ratios are going to go down because we will never be able to get the rent required to hit the rent ratios we need. Your rents are going to top out in different areas at different numbers. Now, we all know that rental prices are up right now, and that's a fantastic thing, but there's still a ceiling on what we could go. No matter if prices are up or down, there's still always going to be a ceiling. If you're in a neighborhood and prices are up and the prices are $1,400 a month rent, and you're trying to get $16 or $17 or $1,800 a month rent, your property might sit. So you need to think about that. Think about that price range that you want to stay in, and then focus on that price range. Do you have a rehab budget that you want to stay within? This is something that I actually have a lot of people come to me all the time, and I have for years. A lot of people that own rental properties, they're not flippers. They're not big on rehabs. They don't want to have to do a lot to fix those properties up. And I was that way when I first started. Where I thought I was coming in and doing $4,000, $5,000, $6,000 worth of work in the beginning. In my mindset was I was doing a rehab on that property. But the reality was I was just doing a make ready. I wasn't rehabbing a whole lot of everything. I was doing the basic stuff that you need to do. But like myself, who I like to buy them low and rehab them completely, that doesn't bother me. That doesn't bother me at all. But another thing that I have a lot of investors come to me that want to own rental properties, they're afraid of a lot of repairs, and the major repairs scare a lot of people. And there's nothing wrong with that. It's just knowing where you sit in this scenario. Lots of investors are afraid of doing roofs. First time I ever had to put a roof on a house, it was scary. I get it. I understand that. And I think for most people, what scares people more than anything is foundation work. And the first couple houses we bought, we had to do foundation work. Man, I was real uncertain of what was going to happen. I had no idea what the outcome would be in that because I'd never done it before. And it is very scary. Now, at this point, I have no idea how many foundations work on houses. I mean, lots and lots. We've done lots and lots of foundation work. So it doesn't really, I don't really think about it a whole lot. My biggest thing with foundation work is just, how many piers are we going to put in and how much it's going to cost? And is it going to affect the plumbing? Because that will have a cost involved with it as well. But for a lot of people, especially if you just want to be a rental property owner, these things can be very scary. Changing out an entire HVAC system. We do this a lot. We put lots of HVAC systems in properties. As a matter of fact, I've got a whole system going in a house on Saturday. So I understand that. So, just kind of sit back and determine, as we're looking at being a landlord, do these things bother us? If we are afraid of these things, then finding people that can help you through that process, finding the right contractors that will give you the right pricing for these items as well. Because when it comes to roofs, foundation, HVAC, depending on what contractor you talk to, your pricing can be all over the board. It can be correct. It can be too low. It can be way, way too high. So we've got to be careful with this. So just understanding where we are as individuals that want to have rental properties are these things that bother us. If they are things that bother us, either we stay away from them, which means we're going to be buying better properties, which means we're probably going to be paying more for those properties. The more work that needs to be done, oftentimes we pay a lot less for those. So, but we'll talk about value add and all that stuff in a little bit here too. So just think about this stuff, because I think these are things that are important for us to know before we jump into it. And that's what I'm trying to point out right now. Because in the beginning, I didn't think of any of these things, and I didn't know about most of this stuff, and I made lots of mistakes, and that's what we're trying to avoid here by doing this. So how are you determining your ARV on a rental property? This is something that when I started talking in the very beginning, and I was talking about a lot of the emails that I see come out for different properties and different things. When people are determining an ARV on a rental property, I see it done incorrectly an awful lot. So, how are we determining the rental rehab that we're going to do on a property? So my example would be, I'll see a deal that will come out, and I'll say, fix this, ARV $150,000. And if you want to rehab this property and flip it, you're going to need to put a $30,000 rehab in it. But if you want to keep it as a rental property, you only need to put a $10,000 rehab budget in it. Now, I'm not going to dispute or argue either one of those repair costs. I'm not going to dispute that it won't cost you $30,000 to fix it, to flip it. And you may only need to spend $10,000 to do your rehab to keep it as a rental property. But what I do know for a fact is that changes your ARV on that property. Because when you go to refinance that property out, an appraisal will be done. And if you have not done the work to justify that $30,000 for that flip, that $150,000 ARV that you were given in the beginning is not going to be $150,000 if you're only doing a $10,000 rehab and just turning this into a rental property. Your ARV is going to drop based on the work that you have done to it. And an appraiser is going to look at the property just like that. And an appraiser in a rental situation, an appraiser is going to do an appraisal on an as-is basis. So I will never dispute the cost of the repairs, because that could be very accurate. But what you have to do is you have to change your ARV in that scenario. And that's what nobody ever does. And that's what I really want you to be aware of, because that is a key factor when you go to refinance that property and turn it into a long-term. If you're doing hard money or private money on the front end to do that rehab, that back end, it can bite you in the butt really big if you're not careful with this. So this is something I think we need to be really, really aware of. And like I said, unfortunately, most of us aren't, because it's never presented to us that way. The wholesalers are certainly not doing this. They don't have a clue, because they don't buy any properties. They're just out there trying to put stuff under contract. They're not doing any of this work. They don't own anything, and most of them probably never have. So they have no idea what they're sending out. And they're sending out what they've been taught to send out and been told to send out. And it's nothing more than that. So, but this is very, very important that we pay attention to this. That's why I'm spending a little extra time here and really kind of harping in on this, because this plays a huge factor in us having success with our rental properties, with us bringing zero money out of pocket at closing, or bringing a whole bunch of money out of pocket at closing. This can make a huge, huge difference. And the lower that ARV is, the more money you're going to be bringing out of pocket every single time. And I don't like to bring money out of pocket if I don't have to. So that's why, I think it's important that we really understand this part of that. So are you buying rental properties for equity over time? Are you buying rental properties for monthly cash flow? Are you buying rental properties as a value play? That's what I do. I'm a value play guy. Or are you buying rental properties as a momentum play? Now, there's nothing wrong with any of these if you know what you're doing, if you're doing it the correct way. Now, let's just talk about the first one, equity. Obviously, all of us want equity over time. That's important to every single one of us, me, you, and everybody. but I also want to buy with equity going into the deal. And when I show some examples and show some numbers, yeah, I will explain that to you and you will understand what I'm talking about. But equity over time is always going to be everybody's play, no matter what. But how long do you have to build that equity? How old are you? All kinds of things come into play there. At my age, I don't have 30 years to build equity in properties. I've got to buy properties with equity already built into them the day I closed. I've got to have equity working already for me. Cash flow. Cash flow is a word I think that is way overused and very misunderstood in many cases. And I'm going to show a cash flow example here in a few minutes as well, so you hopefully really understand what we're looking at when we talk about cash flow. We hear the term cash on cash return all the time, and it just drives me nuts. I think it's the craziest thing I've ever heard, because if we're really looking at how a business runs, and owning rental properties is a business, what are our profits at the end of the year going to be? And quite often, I see investors never look at that. They look at what their monthly cash flow is, and then at the end of the year, they're going, "How come I'm spending so much money and didn't make anything?" Because we're looking at it wrong. And we'll go through that example here in a little bit too. So, but I'm a value play guy. I mean, I like buying properties beat up at the lowest price I can get it, and then bringing that value back and increasing the value on that property. Buying with equity already in the deal the day I close. I want to have equity in that property, and I'm going to show you my example of how I do that and what my minimums are, my standards, what my criteria is when I'm looking at a rental property. If I'm going to buy it myself. And we're going to be talking about single family homes. This is not commercial, because commercial is going to be a little different than this, but I still have my standards for that as well. And then do we want to be a momentum landlord? And this is probably the most popular method out there. This is something that I see done with most of what I call our MLS investors, which is going to be way more of those type of investors than we will ever know. Than the circles we're in, the way we invest is so much more different than our MLS investors. But basically, a momentum play is buying something that's already fairly stabilized, where you don't have to put a lot of money into it. I won't say a lot of money, where you don't have to put a lot of repairs into it, and you can get a tenant into that property fairly quickly. And you'll see people send out deals for turnkey rental properties. That's what I'd be talking about. I know people that flip turnkey rental properties. So they're going to come in and do all the work and then sell that property. So when the day you buy it, you don't have to do anything to it. You close on it and you can put tenants in it. You don't have to put any work into it at all. It's move-in ready. But you're going to pay a lot more for those properties than I'm going to pay. Oftentimes, you're going to be bringing a lot of money down on these types of deals. This is the same type of a scenario that let's use for the example I would use in commercial would be our syndicators. They buy much. They're buying in many cases as a momentum play. They want to add value over a certain period of time back to that property. A very different type of value than I'm adding to the property. Not in all cases, not in all syndication cases by any means, but I would say the majority of them that I see, that's their play. So just so you know, I want to point that out so you know that, because it's important for you to put yourself in one of these categories. How do you want to approach it from a profitability standpoint as you're looking at the deal before you ever get into it? What category works best for me? And for most people, I say the momentum play works, because a lot of people that own rental properties, they're going to own 1, 2, 3 in their entire lifetime. You're going to have a job. You're going to be working a 9 to 5. You're not going to have the time to be out at that property doing work on it all the time and bringing that value back. So I think that that's what makes this a very common, the most common method for most people. And of course, we all think we're going to make a bunch of cash flow, but I'll show you how a lot of that's just a bunch of myths anyhow as we get going through this today. So I think it's just these are just things that I have been taught over the years. I never looked at any of this stuff in the beginning. Like I said, I didn't even know any of this stuff existed. But now that I do, it's important that I help point this out to you, because now we use all these methods for how we look at properties and how we buy. And it's made a huge, huge difference in everything that we do. So, most of you have heard all the horror stories about owning rental properties. Well, I'm here to tell you that they're all true. I can promise you they're all true. So, being a landlord and owning rental properties is not for the faint of heart. This is something that you have to commit to doing, and know that you're going to get if you're going to do this for a long period of time, you're going to find all kinds of different tenants, and you're going to come across all types of different situations. You're going to get every excuse that you ever could have dreamed of getting, and you're going to have repairs that you never dreamed could happen. That is the reality of owning rental properties. So anybody that's sitting back and telling you that rental properties, there's mailbox money, that's not the reality of owning rental properties, I can promise you. And even with having our manager that we've worked with for over 15 years, it is still not mailbox money by any means. There's a lot of work that has to go into rental properties. So now that you know this, why would you want to own rental properties? Why would you even consider wanting to own rental properties knowing that horror stories are going to happen in your life? It's just a fact of rental properties. Why would you want to do that? Well, buying profitable rental properties and owning rental properties is the fastest way to build wealth. Done correctly, by far the fastest way to build wealth. Most investors want rental properties for the wrong reasons. And it's kind of funny that we listen to a lot of the gurus, and they talk through both sides of their mouth. They tell you that you're going to build wealth, and buying rental properties is all about building wealth, but most of their strategies do just the opposite of building wealth. And that just blows me away. I can give an example of I see a lot of the times, and I'm thinking of two particular big companies here in town that do that. That's their teaching is buying rental properties, passive income as they call it, mailbox money as they call it, and they love the cash on cash term as well, which I'm not big on. But they tell you that this is the greatest way to build wealth, which is true. But there's one group that one of their big practices is you buy this rental property, and about every 5 years, you cash out refi on this property. Well, by cashing out refi every time you buy a property, and then you do it every 5 years, you're not building wealth. You're increasing your debt. There's no wealth building here. When we refinance a property, when we go for long-term financing on a property, I always bring my numbers in very, very well. Always have with my lenders, be it private lenders or whoever I'm using, my little banks or something, and they always want to give me money back because I bring my numbers in that good to them. I never take money back. My goal is to pay these properties off. I want to pay down these properties as fast as I can, and then build that equity over the period of time as well. That's building true wealth. But if I cash out refi, no, I just increased my debt again. My ratios just went way through the roof. And now I owe all this money on the property, so all that equity that I had doesn't exist anymore. Now, their idea behind that is take that equity and go buy another property. And if you're just getting started, this might be what you have to do in the beginning. But once you don't have to do this, don't do it. It would always be my recommendation. I never did it from the beginning. I could always figure out a way to buy a property because I've built relationships with private lenders. And now money's not an issue for us to buy properties. So I can understand that if you have to do that for maybe a couple times in the beginning to get going, great, fantastic. But don't continue to do this over and over and over again, because you're not going to increase your wealth. You're going to increase your debt. And your debt's just going to continue to get bigger and bigger and bigger. And that's just not my idea of building wealth. It's other people's idea of building wealth, certainly not mine. So I always want to point that out because I see that taught so often, and nobody really goes into any detail about why they're doing it or anything like that. It's just that they don't want to, they think that they're less of a target if they have a lot of debt. Well, maybe you are, maybe you aren't. I think that's a whole other topic and a whole other discussion and a whole other presentation. So that's just my advice on how I would go approach this. And I want to build wealth. Building wealth is the big part in this for us. And we've never done cash out refis. We refi for whatever we owe on that property, nothing more, because I want to pay that thing down as fast as possible and build equity as fast as possible. That's how I'm going to build my wealth. So, like I mentioned, we buying rental assets, we think of as our rental properties. I don't think of them as rental properties. My rental properties are my assets. And I think it's very important that we take good care of our assets, because that's how I'm going to get that appreciation over time on that asset. And I'm going to get better appreciation because we take care of our rental properties. We take care of our tenants. When we have a problem on a property, we get it taken care of right away. So, I use that word assets, and I was taught this a long time ago by my mentor to think of it this way. They're not just rental properties. These are our assets. We want to take care of our assets. So, buying our rental assets is the fastest way to build wealth, like I just talked about. But however, buying rental properties will not pay your monthly bills until you have a lot of rental properties. This is another thing that I see people do all the time, or I don't actually see most of them do it. I hear most people talk about it. When I get 10 rental properties, I'm quitting my job. We're set for life. Well, I can tell you from experience with 10 rental properties, especially if you've got them financed, you're not going to be able to quit your job. You will in no way, shape, or form be able to quit your job. We need to have a lot of rental properties to get to the point where we don't have to have a job, and that those rental properties can support us. And I'll show you one example of that as we go through this as well. So this is something that I think is another big misconception for us. We think about it wrong, and I think we think about it wrong because we're taught about it wrong. And but we have to make sure that if we're going to have rental properties and live off of it, we have a whole bunch of them, because with rental properties comes expenses. And for me personally, my biggest thing about rental properties is some months I'm going, can we stop bleeding money? I feel like we're bleeding money, with repairs and little things that happen on rental properties. It's just the reality of it. So let's look at some other numbers and things I look at. So this is why I would consider buying rental properties, and the accumulation of wealth. And this is something that we have always done, and this is part of our criteria of how we buy rental properties every single time. So every rental property that we buy has a minimum of $25,000 equity in the property. If I'm going to keep it as a rental property, that's my first requirement. I have to have a minimum of $25,000 of equity. Now, we have many rental properties that we've bought over the years that have double and triple that in equity once we bought them and got finished rehabbing them and putting a tenant in it. So we do this every single time. This is how we're going to increase our net worth. This is how we increase our net worth. So if you could take 10 properties in 1 year and put $25,000 equity in each property over a 12-month period of time, your net worth would increase $250,000 in one single year. That's huge. What other place are you going to be able to invest your money and make that kind of an increase in equity? You're not going to be able to do that in the stock market. I don't know of anything out there that you can do that with. You can do that with real estate done correctly, following some simple rules and some simple guidelines of how you're buying those properties. And like I say, our minimum is $25,000. So let's say if you could do that and you had 5 of them with $25,000 equity and 5 of them with $50,000 equity, how much larger would that number be? Or $30,000 or $40,000 or whatever that number may be. And it's very easy to do that with real estate when you buy them correctly. I've got a friend that, well, actually my mentor, that they just closed several months ago on a commercial deal. And the day they closed on that commercial deal, they put $1.5 million of equity in their pocket. Now, what we have to understand is that's equity. At this point, that's not cash in your hand. This is building that net worth. We have to understand, until we cash out, this is not cash in our hands. But this is more of our savings account that we're going to cash out down the road at some point and put into another investment and grow it even bigger. So that's also something that we have to think about when we're building our net worth. This is not money I'm getting in my hands every time I'm buying. This is money that I'm putting in my net worth category. That money is being put away for a rainy day. That's like when you're doing an investment in the stock market. When you make money in the stock market and you're rolling that money back into your account, that money continues to grow. This is exactly the same thing. It works exactly the same way, but we're doing it with real estate. We're doing it with properties that we own. We're not depending on someone else to make decisions for us. We're making these decisions for ourselves. Fantastic place to be, and puts you in control of your own destiny, which I like the most. I like being in control of what I'm doing. So residual income. So as we add cash flowing properties to our portfolio, we add residual income to our income sheet. Now, this is something that we need to think about also. Accounting is very, very important when it comes to rental properties. And, I see a lot of people go, wow, well, we're putting money on our income sheet. Let's go spend it. Let's go buy a car. Let's go, have fun. Can't do that, because you may need that money at some point for repairs, for vacancies, for all kinds of things. And that's the truth of it. So let's assume that you can add a net profit of $100 a month to your deal. Yeah. So how many doors do you think you need to have at $100 a month net profit? How many doors are you going to have to be financially independent? That's pretty simple math there. So when I talk about having a lot of properties to be able to live off of them, this is a very real number. And oftentimes when people talk about rental properties, and I try my best not to ever do this, everybody always talks about gross numbers, and the gross numbers can look great. Oh, gross numbers can be fantastic. We have to look at our net. What is the expenses coming out of that gross number? Because we always have expenses that come out of our gross number, no matter who we are, no matter what we do. That is reality. So our net profit is everything. And there may be months when you have rental properties where there is no net profit. There may be months where there's negative in your profit column. You're in the red. It happens. It's very, very realistic, and you need to think about this. And that's why it's so important and how you're going to buy these things. All this comes into play. I'm just breaking it down even more from where we talked about buying them correctly, because this is where it's really going to count. This is where your accounting department, your accounting department is going to come knocking on your head saying, what are you doing? Why are you costing us money? Ask me how I know. I've got a very good accounting department and they do this to me all the time. So very important. So with $100 a month, it's going to take you quite some time to be financially independent. Take you a whole lot of time because this is per month. And so if you have one door and you're making a net profit of $100 per month, it's going to take you a long time. How many doors are you going to need? A whole bunch of them. So just keep that in mind as we're thinking about this. Excuse me. So don't get caught up in the cash flow trap. This is what I was kind of talking about this earlier. The cash flow trap that everybody uses. I hear it. I've heard it for years. That's all I ever hear. I think it's the worst way in the world to look at it, but that's how everybody looks at it. And I don't know where that I don't know where that all came from in the beginning, but it is what it is. So rentals will provide you a noticeable residual income after you have accumulated a large number of properties, providing that you bought them right, providing you buy them right. So when I go back to how we buy them, that's where it starts. So this is an example. Now, this is just an example. These numbers can change for a million different reasons, depending on price point, all kinds of things. So take it as an example. But this is a good example because this is a reality of really how this works. So let's say you have 10 properties paid off. 10 properties paid off. That's going to equal about 60 plus properties that you have mortgages on, that you have leverage properties. So you still have a mortgage on it. So you still have to make your mortgage payment and you're making whatever that spread is. Now, like I said, this is just an example and this number can vary for any reason that anybody wants to think of. So don't take it to heart and don't come back saying, well, that number should be 8 properties, that number should be 15 properties. It could be any number of properties depending on the scenario of how you're buying those properties in the beginning, the price point you're buying at, the equity that you're putting into it when you buy it. All those can change these numbers. But if you're just, this is a good example if for the type of properties that we own as rental properties, this number works very well for us. And we have found this to be a very, very true number. So I want you to just really kind of soak that in for a second. So with that being said, you will still need income producing activities while you're building your wealth, while you're building that rental portfolio. You're still going to need to do wholesaling. You're still going to need to rehab properties. You're going to still need to buy mortgage notes. Whatever other activities you do, you're going to need income producing activities because those rental properties are not going to pay your bills. They're not going to be enough to pay those bills every month. And this is one of the things that I see a lot of people don't understand and get it until they're already into where they've got 1 or 2 or 3 properties and they're going, oh, okay, it didn't work like the gurus told me it was going to work. No, it doesn't. This isn't HGTV. This is reality. So keep this in mind. As we're building our rental portfolio, we're still going to have to do income producing activities to keep us alive, to pay our bills, to put food on the table, and all that kind of good stuff. So let's look at the cash flow trap, because I'm giving an example of what I have seen done at seminars. I have no idea how many times over the years. And this yet again is just an example. So numbers could be different depending on any situation. So let's use the example that we've got $1,100 a month rent coming in on a property. And so we've got it refinanced out with whoever, and our mortgage payment is $500 a month. Then let's just say we have taxes for $100 a month, and our insurance cost is $100 a month. Bearing in mind, this is an example, these numbers are going to be different on every property. So this gives us a total monthly expense of $700 a month. And when you're listening to most of the gurus, when you're at tons of seminars, and I'm seeing this done, they're going to be going, your cash on cash return is $400. and everybody's going, "Ooh, great, man, fantastic, $400, man." And you're thinking in your mind, man, that's $400 going in my pocket every single month. Well, doesn't this look a little bit light on what your real expenses might be? It's very, very light on what your real expenses might be. So let's take a look at that. So expenses that are missing. What about vacancy? Are we accounting for vacancy? Because if you have rental properties, at some point you're going to have vacancy. Advertising. So when we go to list this property to get a tenant in it, we're going to have some sort of advertising. Some way we're going to have to find tenants. Most of the time we're going to use the MLS. When we use the MLS, we're going to have to pay commissions. It's just the reality of it. We're going to have repairs. No matter what property you have, there will be repairs. There may be there's going to be maintenance things that we have to do. Maybe monthly maintenance things we have to do on properties, depending on what type of property there is. We might have to do capital improvements. It's the reality, things we have to do. Well, as much as it sucks, we got to evict tenants every now and then. There's a cost involved with evicting tenants. What happens when we evict tenants? We have lost collections on top of costs to evict. Then we're going to have management. Even if we're managing it ourselves, if we're not accounting for a management fee, we're crazy. We've got to account for that management fee. Very, very important. But we don't ever see these expenses when we're listening, we're at the 3-day weekends or the seminars or whatever. There's a million things out there. We don't talk about this most of the time, but these are the most important things that at the end of the year we're going, how come that property costs us so much money? And anybody out there that's listening that owns rental properties knows exactly what I'm talking about. So this is more of the reality of what your scenario is going to look like. With that $1,100 a month income coming in, our $500 mortgage, our taxes, our insurance, and our $700 a month. And then we're going, yay, whoopee, we're all happy about that $400. And then we generally have another $300 a month or more in cost. That's how I came up with the net profit of $100 that I used a while ago, because I know investors that their goal is to make a net profit, especially in multifamily. I've seen this said many, many times. I just need to make $100 net profit off of every door. Well, that scenario may or may not work depending on how many doors you have. I find it to be more of a bad thing than a good thing, but that's just me. And oftentimes that $300 a month in additional repairs or vacancies could go higher. And then we're going to have months where everything does go well. We don't have maintenance, we don't have repairs, we don't have vacancy, we don't have those things. And we have a month where, oh, guess what? We actually did get that $400 in the bank that month. But you want to hang on to it because you're going to need it for a rainy day. And that's where, then that goes back to when we were talking about the residual income. It all goes hand in hand. So be very mindful of this and don't get caught in that cash flow trap that is thrown out there all the time. It's thrown out all the time. So, so how much can you pay for a rental property? Well, the biggest factor determining your maximum offer is going to be the cost of your money. Who is doing your financing? Where are you getting your money from? This will play a huge role in how you can buy. Now, if you can get really, really cheap money, then you can probably pay a little bit more. If you're going to get more expensive money, then you've got to be more aware of how much you're paying for those properties. We have a lot of rental properties that we pay. I would say on our rental properties, our interest rates on our loans are 5, 6, 7, and probably 7.5. Maybe we may even have one that's at 8%. And I'm fine with all those. I'm fine with paying all those interest rates because I bought those properties correctly in the beginning, and I still hit my rent ratios that I need to hit. So, but as I pay more for my interest, I have to buy that property a little bit lower, holding it over a longer period of time. So cost of our money is very, very important. So where are you going to get your money from? Who are you going to be borrowing your money from? start thinking about that. Start talking to people like myself, talk to small community banks, all kinds of things like that. So you have a good idea and find out. And obviously we're in a time right now where interest rates are up. Interest rates are up. And I was actually, we had a meeting with our banker this morning, and what was he saying? Rates are at 6.5%, 7% right now. And that's for your residential owner-occupied properties. If you're an investor and you're trying to get bank money or get conventional financing, anything like that, you're probably going to pay a little bit more than that. You're probably going to be paying a little bit more than that. So be very aware of this and go out and talk to lenders. Talk to lenders and find out where you would be, come up with a few scenarios, and you can determine some numbers, and that'll give you a really good idea when you're out looking to buy a rental property, where you want to be, what category you want to be in. And of course, then there's a lot of other factors to go into play as well. So let's do this example here. So this is examples of how we have bought for years, and we've got, gosh, I don't know, I have a bunch of properties that we have bought in this $80,000 range. Now this is our cost. This is when we bought the property, our rehab, our all-in cost. We've been in that $80,000 range many, many, many times. And I'm really, happy in that range. And we could use let's say that we bought the property for $50,000 and we put a $30,000 rehab in it. So you have a better perspective of what I'm talking about, where I'm coming from. So if we get that property, our all-in cost is $80,000, and I use hard money at 12%, my interest payment is going to be $800 a month. So obviously, if I'm keeping this as a rental property, I want to get this property done as quick as possible, because I'm paying my highest amount of money right now. And then on top of that, I'm going to have my taxes and insurance that have to be added from a cost perspective to that $800 a month. So it's important that I get that thing done quickly, get it refinanced out, and get a tenant in there. So then it's time to refinance out it. And if I can get 7% interest rate from one of my lenders on a 20-year amortized note, well, now my payment goes to $620 a month. So I've just brought down my cost, increasing my cash flow a little bit more. But we still have to add our taxes and insurance to that, and those are going to be monthly expenses. We haven't even talked about repairs or any of all those other costs that they're going to come into play at some point. But then if we're lucky enough to get a 5% interest rate on a 30-year amortized note, that could take our payment all the way down to $429 a month. So do you see what I'm doing here is, when we go in and buy it, yes, we're going to pay more initially when we buy it because of we have to rehab the property, and I'm going to pay a higher interest rate on my short-term financing. But as you look at your long-term financing, looking at 20 years, 25 years, 5, 6, 7%, you're going to drop that number tremendously, which is going to help you. That's what's building that cash flow. So I'm looking at all these types of scenarios. I'm running these numbers very quickly as we're looking at what our exit strategy is going to be. And if we're keeping this as a rental property, these are the kinds of things I'm going to look at myself to help me better know what's going to be my best exit strategy. Do I really want to keep this property as a rental property? Am I going to hit my numbers as a rental property? Now, when we go back to that all-in cost of $80,000, if I've got that property and my all-in cost is $80,000, that means my ARV needs to be, 130, 140, 150 on this property. And generally, that's how we've always bought them. Our ARV is going to be in that 130, 140, 150 range. So I'm buying way under 70% LTV, and now I'm going to be able to hit the rent ratios that I need to hit. So I'm going to have profit, not a month-to-month cash flow. I'm going to have profit at the end of the year, where it's important. It's not a month-to-month. It's an annual thing. That's how we need to be looking at. That's how your books are looked at. So let me give you a little bit more of an example on when I talk about rent ratio, because I know people get confused about this sometimes. So every time, let me see, most people, like I said, most people don't even know what rent ratio is. When I bring up rent ratio, oftentimes people go, "What are you talking about?" And I'll say, "Well, you were listening to that guru, and they told you that you were going to, make $150 a month cash flow. What's your rent ratio based on that cash flow?" And most people don't have any clue what it is. And like I said, the national standard is 1%. Well, I got to tell you that when I start my evaluations on my rent ratios, I start my evaluation at 1.8%. That's where I start it. That's where I start my calculation. Now, I can change my rent ratio based on the cost of my money. And even more so than the base of the cost of my money, based on my LTV on the property, all these different factors. I can run those numbers very, very quickly and know, is my rent ratio going to be 1.8, 1.7, 1.6? When I get to 1.5, I'm gonna start backing up. I mean, we've done 1.5 on a rent ratio before, but it was, but the number still worked in that situation. But I'm going to really be looking at that. It's really important because this is where I'm building that cash flow, so we do have profit at the end of the year. That's the goal, is to have profit at the end of the year. So let's just do a couple little examples to hopefully help you understand. If I have a rental property that I am all in at $65,000, so my all in is $65,000 on this property, and I've got an ARV of $100,000. Well, times 70% LTV gives me $70,000. So that means that I'm buying this property at 35%, with 35% equity in it. I mean, I'm golden. I mean, any lender out there is going to lend on this deal without even giving it a thought. This is a great, great number to go in with. So let's look at our rent ratios, because this is what I'm looking at. So if my rent in this example, I'm getting a $1,200 a month rent, and my all-in cost is $65,000. I'm going to take my $1,200 and divide it by my $65,000 all-in cost. That's going to give me a 1.8% rent ratio. So I know that when this becomes a rental property, man, my rent ratio is there. So I take the property down, and my initial loan, I'm using a hard money or a private money lender, and I'm paying them 12% interest. So at $65,000, my interest payment is $715 a month. So I know I got to get that rehab done as quick as possible. But now that rehab's done, we get a tenant, I refinance that property out for my long-term financing, and I bring that interest rate down to 6%, 7%, 8%. That interest payment that I'm making, my number just dropped by $200 or $300, maybe even $400, depending on how low I can get my interest rate. And now by lowering my payment, my interest payment, now what did my monthly cash flow just jumped up $200 or $300 or $400 on top of what, if I'm getting $1,200 a month, and we've got $750. So let's go 1,200 minus 715. So that puts us at a $485 a month cash flow. Now, taxes and insurance have to go in on top of that, and we haven't accounted for repairs or vacancies or any of that at this point. But if I take that $715 a month, and I can take $200 or $300 off of that by lowering my long-term payment, now that my payment or my cash flow jumps up to $600-700 a month, $550 a month, whatever that number may be. Now I've got some meat in that property. So I'm covering my taxes, I'm covering my insurance, and I'm building money up in that account every single month. So when we do have a vacancy, we do have repairs, we've got money sitting there to take care of that. And like with any rental property, like any landlord, with any luck, we have low repairs, and we keep tenants in our properties for a good long time. And if we take care of our properties, we're going to be able to do that. This is how I look at when I'm looking at my rent ratios. This is the kind of stuff I'm looking at. So I just think it's really important that we, and you can use these numbers in different scenarios. You can change your percentage, but you take whatever your rent's going to be and you divide it by your all-in cost, and that's going to give you your rent ratio. And then you can play with that number based on whatever situation you have. This has proved to work for us very, very well over the years. And this is the method I use. And this is, like I say, guys, this is simple math. I don't need to use confusing math or difficult math. This is simple stuff here. And I like to keep it as simple as possible. So, just take a good look at this and take notes or ask questions and use this formula, and it will help you tremendously, I think. So through this, you should have a very good idea of how you need to buy rental properties. I'm not telling you have to use any of these, but this is how we've bought them, and we've been very successful doing this. You need to figure out your maximum allowable offer formulas based on all the factors that we've gone over here. And everyone, I say in this room because that's where I did this in a room for my last presentation, but everybody that's listening, everybody is able to buy and pay different amounts for rental properties based on your situation, based on the equity, profitability of those properties. So hopefully this has given you a lot of very good information to be able to do that with, and you can have some success. And I think as we go into next year, we're going to be seeing more and more opportunities with numbers that are going to work closer to this. We haven't seen these numbers working, or we've seen a lot fewer of these types of properties over the past several years because of the economy. But I think we're going back to where we're going to find some good properties like this again. And that's always what we always want. And, because, we can buy rental properties a lot of different ways, but the nicer properties we buy, the more we're going to pay for them. Which means that, I'll share my screen here real quick, which means the more that that we pay for them, the more money we're going to have to bring out of pocket. That's just, and depending on who you're getting your financing from, even if you're getting it from me, I mean, we still work off 70% LTVs. You got to think about it. If your lenders are working off of that, as we're buying, we need to be working that same formula. But for some reason, people don't do that. And we have people that are bringing crazy amounts of money down when they buy a property. So that's what we got for you today. Angie, do we have any questions?
Have you ever done B&Bs?
Airbnbs?
It just says B&B.
I'm sorry?
It just says B&Bs.
Yeah, well, I'm going to assume that we're talking Airbnbs. Those are short-term rentals. I have not done short-term rentals. I think, there can be some very good short-term rentals out there. I know some people that do some very good short-term rentals. But I think a lot of them are a lot of flash, and it goes back to the same thing with short-term rentals versus long-term rentals. No matter which side of it you're on, there's going to be expense involved. And it's rare when we hear anybody on a short-term rental, Airbnbs or whatever it may be, nobody talks about the expense side of short-term rentals. And the one thing about a short-term rental is you're going to have far more expenses than I'm going to have on a long-term rental in most cases. You're going to have monthly maintenance fees and things that are going to cost you that I may not have on my long-term rentals. So at the end of the day, everybody I hear talk about short-term rentals always talks about the gross numbers. Let's break it down and see what the net numbers are. Then we can determine if it's a good deal or not. I'm not saying short-term rentals are bad by any means. It's just something that is not for me and hasn't been for me. I'm not saying I will never do it, because I certainly may if the right scenario comes up for it. It's just something I haven't done at this point. Anything else, Angie?
A bunch came in while you were talking. How are you finding rental properties in this market?
Well, rental properties are tough right now. And for the scenario I gave you on how we buy, to be quite honest about it, we haven't been finding those properties. They're with the way that inflation has kind of come around us, and it's not so much the inflation and the property values that make it more difficult. It's people's perception, your seller's perception, because of everything they see on the news. So it's harder to, when you're talking to your sellers in a house that's really beat up and needs a lot of work and you can't afford to pay a lot for it. The real answer to that is how good are you at talking to your sellers and educating them that their property really is not worth the value that they think it is. So it's made it much more difficult, hands down, made it much more difficult. And we haven't bought any rental properties the past couple of years because of that. We've still found deals, and what we've done is flipped them instead of keeping them as rental properties because it doesn't hit all my criteria. And I laid out different criteria, equity, rent ratios, and if I can't hit those numbers, we're going to flip it, or we're not going to hang on to it. What else you got, Angie?
Who is your preferred lender and why?
Well, my preferred lenders are private lenders. And why? Because we sit and we come up with our own terms. And if you've seen any of my private lending presentations, you'll see you know exactly what I'm talking about. I will say that most of our private lenders are most of our long-term lenders are private lenders. If not, we do use some of our small community banks, and we have used Texas Citizens, which actually is not Texas Citizens anymore. They just got bought, and I believe it's B1 Bank now is the name of that company. So now they've become a much larger bank. So going forward with them with rental properties, will that work the same? I don't know, because we haven't gone down that path with them yet with the new bank. But we've probably done 7 or 8, maybe 10 refinances with them in the past. But it was just like working with a private lender, bringing them to them at 70% or less LTVs, no money out of pocket. The banker we worked with was an investor himself, and he was very well known in our industry. He's just been moved up in the company. He doesn't do that anymore, and so we're working with new people. But they're a good bank. I would say that talk to your small community banks. If you're going to go to Wells Fargo or Chase or big banks, you're not going to get the service that you're looking for, and they probably won't want to do business with you if you don't have a very big portfolio and good large financials. That's the kind of stuff they're all looking for, but it's much tougher with the big banks. So your small community banks are by far the best to talk to in that scenario. They're looking for business. They're looking for business people like you to do business with. What else you got, Ange?
Would you recommend using credit unions for financing?
Credit unions can work. I actually have a friend he used to use a lot of credit unions to do his refinancing. I will say that our experience with credit unions were in 2020, when everything was starting to happen. We were actually talking with a credit union that was recommended to us by this individual that has always used them, and we were trying to do some very different things, less conventional type of things with them, and we were moving right along very, very well. And then after about a month working with them, getting them all our financials and going through all that rigmarole, they shut everything down with that credit union. They stopped all business with everybody, and we never were able to get that relationship back after that. But credit unions, I think, could be a very good avenue. And I would, especially if you know a credit union and you know someone with a credit union, by all means, I would talk to them. Without a doubt, I would talk to them.
We have a question. How does wholesaling work, and would you recommend it for a beginner investor?
Yeah, wholesaling. I mean, wholesaling is it's not what it used to be, but Basically, wholesaling, is going out and getting a property under contract with a seller and then assigning that contract over to a buyer, someone like myself, to close on the deal. But as a wholesaler, I haven't done a wholesaling presentation in a very, very long time. Maybe I need to do that here fairly soon. As the wholesaler, you've got to have meat on the bones for all parties, and most wholesalers don't do that nowadays, which means most wholesaler deals don't ever move, and the deals are killed, which always goes back as a burden onto the seller, which I never liked that scenario, but that's kind of how a lot of wholesalers work now. They just put anything under contract, throw them against the wall and see which one or two or three might stick. And so if you can go out and find deals at 70% LTV, maybe even 75% LTV minus repairs, then you call me and I'll take a look at them without a doubt. But we've got to have good ARVs. We've got to have good repair estimates to be able to determine that. Because if I look at it, I'm going to run my numbers on the ARV side, and I'm going to look at the repairs from my side of what's going to cost me, and I'm going to determine that number. So if you can hit that number, by all means, we'd love to find more deals. I mean, deals are everything. So wholesaling is a good way to start. The key is finding the good buyers for how you're buying them. We could have a conversation after this on that if you wanted to call the office or something. We can set up a time to talk about that.
Which two areas in Houston are the most profitable for you in your rental portfolio?
Well, I would say Inwood. The Inwood area, we've always liked the Inwood area. I will say that because of the past several years, values have jumped up crazy in the Inwood areas, and there's a lot of different sections through Inwood to look at. And then we were always very big, and have always had done lots of deals in all the Sunnyside area. But there again, that's a whole other area that's gone through a huge change. And values have changed tremendously over there. It's much harder to find those types of deals over there that we used to find. And what we found that we have done over the past several years with some of our rental properties in Sunnyside is because of that, we've actually turned them into owner finance properties. And so we still make very good cash flow off of them as owner finance, but we don't own them anymore. We're just the bank in that scenario. So those are probably the two best areas. I still think you can find very good deals in both those areas. You're just going to have to look a little harder maybe to find them.
How many years before you refi and pull equity out of another rental purchase?
Well, if you're listening to most of the gurus, they say about 5 years. Some of them say 3 years. At 3 years, you're not going to have any equity. We don't do that. We don't pull equity out of a property. We don't because we don't have to. If I'm going to buy another property, I have plenty of ways to raise money to do that. If you don't have any way to raise money, and you need to have some money, pulling equity out of a property can be a way to do that. And typically, if I ever recommend someone to do that, that's going to be if you're younger, so you have time to make that money back. And if you don't have any other means and you need money to get into a deal, we have always been able to raise private money and not bring money out of our pocket, or very, very little, very, very often we've ever had to bring money out of our pocket, because we've always been able to find deals with the 70% minus repair scenario. And we still do that to this day. It's not like that those deals are out there. We've got to look and we've got to find them, but they're out there. So, if you don't have to pull equity out, because the idea is to build wealth. And the way we're building wealth is with pay down and with that property improving in price over time. So I like that scenario. So we don't pull equity out, but that would be my scenario. you're not going to have a lot of equity in a property probably till about 10 years. Actually, depends on how much you need. But I see a lot of the gurus, your lifestyles, your total wealth academies, those guys talk about more in the 5-year range, which I'm not big on, but that's what they talk about. You there, Ange?
Yeah, I am. I just have to keep following because they keep popping questions in.
Okay.
Do you use cap rates in your numbers for your criteria? If so, what range it, or what are your ranges?
Well, cap rates come into play for commercial. We don't use cap rates, don't come into play for single family. A cap rate is going to be a commercial deal, multifamily, storage facility, single tenant building, anything like that. We're going to use cap rates. And for me to buy successfully, I'm going to have to be at about a 9-10 cap. And if I can get it higher, if I can get it 11 or 12, then that's even better. But for us to be able to buy the way that we buy and be successful, we're going to have to really be in that 10 cap range. And, we haven't seen that in a number of years. We've been in the 4 to 6 cap range for many, many years. But now we're starting to see properties that are popping up in the 8 and 9 and 10 cap range on the commercial side. But when we start breaking down the numbers, and of course, like I said, it goes back to the cost of your money. The cost of your money is everything, because you might be able to change, that cap rate by a quarter point, by a half a point, based on the cost of your money. But for us to be successful, I would say that for me personally, I'm going to be looking at a 10 cap for me to want to move forward on a deal. And they're still very hard to find out there. They are, but we're seeing them more and more depending on the asset class of commercial deal that you're looking at. So if you want to find, there's some deals out there now that are 12, 14, 15 cap, but those are typically hotels and motels. And what the people that I see that are doing those successfully, they're converting those into another type of business. And if you have a model to do that, that's where you're going to find your best deals right now, but you've got to be able to do something with it. You can't turn it back into a hotel or motel or you won't have success with it. And then it's not a good deal.
Which area in Houston do you see is upcoming for a great rental home market?
I think I go back to the older areas. Like I said, the Inwoods, we used to love Acres Homes, but another area that has changed tremendously. You can still find good deals in Acres Homes, but it's a much different market than it used to be. They've done lots of revitalization over there, just like they've done in Sunnyside. But if you're going up and down the 45 corridor, outside of town, the north side of 610. So if you were on 45 going northbound at 610 north, all the way up to Beltway 8, I think there's huge areas that's a huge, massive area. I think there's fantastic areas all through there for great rental properties. Great neighborhoods that fall into that. They used to fall into that 120, 130, 140 ARV range all day long. Now that obviously has increased over time, but still being able, if you still buy them at the proper percentages on your numbers, then it doesn't matter. But I think those are great areas. To this day, I still love A-Leaf, Mission Bend. I think those are fantastic neighborhoods. Anything we've ever done in those neighborhoods have been golden. Obviously it's our Chinatown area for the most part over there now. But if you can find deals over there, those are great areas as well. Those are some of my more favorites.
Well, ironically, you answered the next question with that answer as well. So then, would you recommend beginners or would you recommend a beginner to start finding properties with MLS or some other avenue?
You're not going to find properties on MLS. You're not going to find deals on MLS because the numbers on MLS, they're looking for retail pricing 99% of the time. If an investment deal does come on MLS, there's going to be tons of people on it in seconds, and they're going to drive the price up. So I would not recommend MLS. That's you can find all kinds of properties. You just won't find properties with numbers that I would buy or most investors like me would buy. Marketing directly to sellers has always been very popular. Getting out and learning neighborhoods, areas that I just mentioned, going and driving those streets, driving for dollars, knocking on doors. It's one of the harder ways to do it, but it's definitely one of the most effective ways to do it. Especially if you're newer, you need to get a little bit of training on how to talk to people, and you don't have to come in with any kind of a hard pitch. It can be a very simple conversation. You knock on the door, you have your business card, you knock on the door, say, "Hey, my name's Steve Vigil. I'm a local investor in town. We're working in the area. We're looking for properties to buy. If you ever consider selling your property, I'd love to talk to you. Here's my business card," and leave. That's it. Just something very simple like that. I'm not asking them for anything. I'm not trying to pitch them or sell them on anything. I'm just telling them who I am. If you're ever considering selling, I'd love to talk to you. Boom. But you got to go out and knock on a lot of doors and do that. But it's very effective. And the harder things that we do are oftentimes the most effective things that happen. And what we used to do when we do that, we would also have a flyer in our hand. So if someone didn't answer the door, we'd leave a flyer on the door, and we'd get calls that way as well. Those are going to be your most effective ways, I think, right now to go out and actually make things happen. We have a program now where we are working with realtors, teaching realtors how investors work. And if you can find some good realtors that can be trained and they can bring you pocket listings, properties that have not been listed yet, properties that need a lot of work, that can be an opportunity as well. And we're working with a lot of realtors right now to try and train them for that very scenario, to hopefully have them, as we train more and more realtors, have them start bringing more and more deals to the table for us to look at, and us passing those deals out to other investors as well. So those are the things I would look at and things I would do.
I believe that is all.
Wow. Okay. Well, lots of great questions, really good questions today. And thanks everybody for asking questions. And if you think of something after this is over, you can always call us at the office. I'm happy to answer any of your questions now or at any time. It's never, ever a problem. I hope, and if I answer something that wasn't exactly how you were asking the question, please reach out to me and let me know so I can answer the questions correctly if I didn't answer them how I needed to. But guys, I want to thank you so much for joining today. This has been a great workshop. I hope you got a lot of great value out of it. That's why I do it, to try and teach you some great things. And I look forward to our next one. I don't even know when our November one is, whenever the second Wednesday is. I don't know what the date is. And get tuned in. Come and join us for our meeting this month on the 27th at where the Quest office is, 17171 Park Row. And we'll do some great networking, have some great education. We're going to be doing some case studies on different deals, which would really be a lot of fun. Lots of good questions to ask at a meeting like that. And we'll have we got a couple great giveaways at the end of the night, and we're going to make a really good announcement to everybody as well. Something that's going on with the Wealth Club and all of our SVSM companies. So come out and join us on the 27th. And you're not getting our
Lunch and
emails.
Learn is November 9th.
Oh, okay. Our Lunch and Learn is November 9th, our next one. And I don't remember what the topic is either on that one. I'm totally blank on it. But we'll start marketing that and sending that out to you. But get joined in, guys. Get more education. You know, we're in our fourth quarter. We're at the end of the year. This is when we need to really be planning how we're going to finish out this year and how we're going to go into next year, where I think we're going to see a lot more opportunities that we haven't seen in a long time. I've got my fingers crossed we're going to see those opportunities based on some of the craziness we see going on in the world and all that kind of good stuff. But guys, thanks again for joining us. I know I'm kind of rambling on here. Sorry about that, but loved having you, and we look forward to seeing you next time. Until then, have a great week and a great month. Bye.